presentation, but then I realized it happened yesterday.
Oh, that's okay. We're doing Pitch Doctor later, so you can certainly help out there.
Okay. Okay.
So we're now recording. So Daniel, thank you very much for joining to the latest session of the expert stage at the global Hack From Home Hackathon that we've been doing this weekend. It's been an exciting couple of days here on the expert stage. We've had anthropologists, economists, ethicists, various business studies leaders, and public health experts, all coming and contributing their ideas to the hackathon, and giving the benefit of their insights to our hackers, who of course have been hard at work formulating their ideas, getting together their teams, working out what they want to build, and now just beginning to build it as we progress to our 12:30. No, yes, getting it wrong now. Our 23:59 deadline. That's 1 minute to midnight British Standard Time for getting in the submissions. So for all those of you listening, make sure you don't forget to get that in. Now, the purpose of this hackathon has been to bring people together, to empower them to fight COVID-19, empowering them in terms of creating applications for citizen science, care in the community, and mass mobilization. But in empowering them to make these changes, to also do so in ways that still protect the freedom of individuals and their control of their own data, and of course central to both of those, their privacy. Now, thank you so much, Daniel, for coming to speak to us about what makes a world-changing idea. It's a pleasure to have you here, particularly someone who's invested in so many interesting businesses, and with your background at IQ Capital. Yeah, we look forward to hearing what insights you have to offer. Over to you.
Thank you very much. First of all, thanks for the opportunity to speak. And today, I'm just going to speak about a bit about what it takes to make a large company. So I'll just start sharing my screen now. So I hope everyone can see that. So I've taken the
yes.
So just to answer the thesis question. What changes the world from a technology perspective and an investor perspective. So my name's Daniel Carew. I'm a principal at IQ Capital. We're an early stage venture capital firm in the UK, situated in Cambridge. We've been around for 20 or more years, now on our fourth fund, and have approximately $400 million under management. We do typically 12 early stage investments a year. And we do seed and Series A. So that means before and after product market fit, and we invest in teams very early on and help them get to market. And really the background or investment thesis for IQ is that we look for a breakthrough in what we call deep tech. So that means science, computer algorithms, that sort of stuff. So we're not consumer focused. We're very much focused on that. So there must be IP, and the idea is if you've got a breakthrough, we'll invest and help the team get to market. And maybe that doesn't happen the first time, but it will eventually. And we've got a lot of experience in doing that over the last few years. So a bit about my background. I started off as an engineer, and then I did a PhD in biology and chemistry before working in management consulting. And I guess the thing that drove me was that I really like technology, and the same with everyone, I'm sure, who's involved in this initiative. I believe that it can change the world for the better. And for everyone who's currently working hard, I really do hope that you come up with something amazing and you can go and change the world. And what I'm about to speak about is how I think the path to do that. So really, the thesis that I sort of landed on after a while is that a large company is the best vehicle to change the world with technology. So I started off as an engineer and very early on saw a lot of technology, which was great, but just never made it out into the world. And I never really understood that. And I thought that if I went into the lab, I can, develop better technology. And I did. But again, it just it was trapped in the lab. It really requires a commercialization vehicle to get it out and get it out in the marketplace. And even in the situation we find ourselves in today, it's large companies like 3M, LG, who have the systems and the teams in place to be able to make a difference when the time comes. So I structured my talk in 3 parts. So I think we're a bit short on time, so I'll only be able to go through part one, but I think it's the most important bit, which is what drives an investor and typically a VC. And I've tried to explain, the talk is aimed at someone who's like myself, an engineer or a technologist. Perhaps you program, you've got a good idea, and you're trying to be able to articulate that and explain why it is you're going to build a large company, and to be able to speak the language of funders and investors, be able to get the capital to build the teams that you'll need in order to make a difference. So I'm going to speak at it from an investor sort of language and standpoint, and then I'll show you the logic in terms of how people look at investments and what it takes to build a large company. So the first part, what drives an investor? So the first question is, what does a large deep tech company look like? Well, you can go and look at various sources, but if you look at US statistics, they start with 500 employees. And an average financial investor is someone who knows the stock market, perhaps knows accounting, doesn't really know the technology. And what they do is they use this, what I've structured here, which is what's called a bridge, where you start with a number of employees and you go and find statistics. And we try and figure out what a large company might look like sort of as an endpoint. So, I've said that we're looking at a deep tech company, which is sort of any kind of complex industrial or someone that has a breakthrough. And we said 500 employees. I've picked the aerospace industry, which you can see down here, to get sort of statistics, which can be used to build up what the endpoint might look like. So this has a revenue per employee of 378,000, a net income of this. Okay, so starting with 500, we multiply these numbers together and we get an implied revenue of nearly 200 million. Now there are ratios that the finance industry uses in order to, which are the enterprise value to revenue multiple. So we're trying to figure out what the final valuation of that company might be. And if we use this, which is 1.5, which you can go and look up, and you can pick any company and go on their stock market and find out what this ratio is. We're looking at an enterprise value using this EV to revenue multiple of approximately 300 million. So we've defined that sort of as the endpoint. So here I've tried to lay out, working backwards from 300 million or 200 a bit, what the growth of a large company looks like over the timeline and the various sort of phases that it goes through. So over here, on the top, we've got one, the number of years, and I've broken it down into concept, research, business setup, product development, commercial deal, operational scale up, and expansion. And I've plotted the number of employees, which is sort of the statistic that we're bridging off of, and from revenue to get a valuation number, which investors are really interested in, and then an investment amount. So I've plotted it here in terms of the number of years that it takes to go through each one of these stages, the number of employees typically, which are at each one of these stages in the company, and what the revenue would look like, as you might expect. Now this would vary industry to industry, but again, we're kind of looking at an aerospace type example. And finally, you can predict what the net income might be. And from that, you can come down, and I've used what's called the rule of thirds, which is that the investment, which is taken at any stage, is approximately 1/3 of the valuation. So I've put down here what typical investment amounts might be. And from there, you can see what the valuation might be of that company. And we nicely sort of come on to the end result that we have there. And here I've sort of broken down by who those investors are at different stages. So initially you've got family, grants, university, then seed investors, angels, and then finally sort of here where we begin to get interested around early stage or Series A. So if I look at this from a Series A fund perspective, I'm looking at it from this red arrow. I look at a company that's at this stage. I invest money. What I'm really looking for is people who invest 60 million over the next 4 to 6 years to get it to self-funding. Self-funding is really the point at which the company is safe. And after that self-funding stage, then at some point you can sell and get your money back and do the entire thing again. So if we use this break-even point, which is most important on a deep tech type company, and we work back a few years, you can see the funding risk increases as you go earlier. And for any investor, they're trying to figure out whether the funding risk is lower than the valuation and what your future probability is. So really, at this stage, me as an investor looking at your business plan, am I confident this company is going to exist in 3 to 7 years and then I'm going to get my money back? That's really the question that anyone is trying to solve in order to get get to a large company and be able to fund large companies. So how does it really work, right? Well, all of it is basically driven by mathematics behind the scenes in terms of investors. So I think the thing to know is that there's never enough time. Investors are always short on time because you're always looking at a large number of information. Everything's a quick decision. So when you go to speak to an investor, you can assume they have a 100 million fund, and we'll use this as an example. Most investment funds have a 10-year life. They invest for 5 years and they exit for 5 years. So typically they have a ratio. They reserve for initial investment and then a half for what they call follow-on investment. So different funds have different ratios. This one I've assumed a 1-to-1 ratio. Others might do 1-to-2, 1-to-3. And it's important, to consider when you're looking at an investor who, that's one of the things to ask. You want them to be there for the long run, especially if it's an early stage investor. So from that, we can say 50 million, and we can work backwards, say 20 investments, 4 per year over this 5-year investment cycle. So we get to 2.5 million for an average first investment. Now, most funds, spend a third of their time on entry, so deciding on investments, a third of their time on management, and a third of their time exiting or doing other sorts of things. So they've typically got 4 months to make 4 investments. So that's 1 month each. And you might say, well, that's pretty easy. Just make 4 investments and then go to the beach. But it doesn't really work that way. So there's typically an investment funnel. So 150 companies come in and 1 comes out in an investment. And those ratios are approximately the same across most investment classes, from seed all the way to series D or F. So, and here you can see what a typical investor will do. So they'll have a 10-minute call, or 10-minute look at your pitch deck. They'll have an hour-long call if they're interested. They'll spend 2.5 days preparing a short paper, and then another 2.5 days working on deal terms, and then 3 weeks in due diligence. And then they'll allocate 2.5 million to you as an investment, and then they'll spend a lot of the rest of the time sitting on your board and helping and so on. So really the question becomes this: after 10 minutes, do I think this company is going to exist in 7 years and I'll get my money back? So it gets a bit more complicated. So again, like I said, everything's dictated by math. So most funds have what they call an internal rate of return, which is called a hurdle rate, which is approximately 10%. And this means that every asset class needs to return something which is approximately the same. Otherwise, investors will put their money elsewhere. And we have investors in our fund, etc. So, from here you can calculate using this internal rate of return. You get a 2.6 times after 10 years, assuming a 10-year time for the fund. Again, 100 million fund size. So we've got to return 260 million after 10 years. Statistically, you can again go and look at what the probability is that we'll have a failure. And you assume 50% failure rate of early stage companies. And here I've plotted sort of cash in and cash out. So 5 of these companies return 0, 2 return 3 times the investment, 2 return 6 times the investment, and 1 returns 10 times the investment. An average overall, it comes out to 2.8 times, cash invested versus cash out. But initially you don't know, right? You don't know which of those pots these companies are going to go into. So you need to really keep shooting for this one here, which is the thing that most VCs talk about a 10 times return or a fund return. So the question becomes more complicated. So after 10 minutes, do I think this company is going to exist in 3 years? And I'll get 10 times my money back. So the VC fund approach, right? So really at this stage where I think most of the people in this hackathon are going to be looking at, they'll be looking at family or hopefully seed investors. And the investor concern is they really need to predict the market after 10 years. So the way they do that, as most people do, is they say, okay, well, it has to be a really big market. There's got to be a competitive advantage that will still exist in 7 years, and it needs to be an accomplished team. So, this changes. So as you get up to the large company, then it becomes increased management and metrics focused. And when you get to the stock market, no one really cares who the team is. But early on, you're very much backing the team and the technology and the market's focus. So really the question is, after 10 minutes, do I think this company is going to exist in 3 to 7 years, and I'll get 10 times my money back? And really the thing that you need to get to is you need to put forward a case that shows that most reasonable investors are going to think so, And then if I don't invest, I'm going to miss out. I'm going to look stupid. Okay, because no one wants to think that they missed out on the next billion-dollar opportunity, and that's how they look at it. So when you're early on, you need to really focus on these three things when you're looking at investors and then after further 10 years, you'll get to build a large company. So at that point, there's a further two parts to the presentation, James, which are market analysis and competitive analysis. I don't think we have time to go into that here, perhaps at a later date. I think early on for the market analysis, you have to prove that it's a very large market. You have to prove that you have some way to get into the market and you're making sales. And from a competition perspective, you have to prove that you have some sort of overwhelming technology advantage or other way to get into the market. And those are the two primary things. You need to prove that there's a way to get into the market and a way of defending it. And then your team is the people who go and make that happen. So I think that I'll stop and sort of take questions.
Well, thank you very much for that, Dan. That was incredibly interesting. We'll probably overrun by 5 minutes. We have 5 minutes to the hour, but we started a bit late. So I'm quite happy if you felt that you wanted to explain a couple of slides on that market analysis section. You have a better idea of how long that section is than me, but we can certainly do.
Well, let me go to I guess I'll just skip ahead to this, I think, which is the way to think about market analysis from a pitch deck, a due diligence, and then what happens later, right? So early on, the message you should be proving for a pitch deck is people buy what I'm selling, or I have proof that they will. The first approximation is that the edges of the market won't constrict sales. It's big and we're small. And really the message is, don't worry, if I screwed up, the business will still survive and your investment will be safe, right? So you've got time. In the second part of due diligence, an investor will look at the pipeline. So they'll look at people you've sold to, people who know them, people like those who you've sold to, and people who need the product. And from that, they'll look at your pipeline, the dynamics in the pipeline, and use logic to try to extend that further in terms of proven in sales, such that if they increase the sales team, what do they think they can get to? And that is checked against external market reports and external market factors. And then, deeper still, so depending on if you're a very late stage fund or a larger company, they'll begin to look at funnel dynamics, stages to sell and execution, and they'll begin to look at mini markets within your market and distribution and access. And they'll try and predict how the future market is going to grow and segregate and so on. And then you can still, at some point people start to do scenarios analysis around competition. But I think, for most people, this hackathon thinking early on, the first step to getting a big company is this: prove the market, prove that you can sell something, and that you can eventually have a path to a large market. Now, if I skip ahead to the competition analysis, I just wanted to there's many ways of looking at the competition, but again, I've sort of
lots of diagrams.
Yeah. So this is kind of all the different ways that I've ever seen people talk about their competition, and different ways of presenting how they're going to win. Again, probably don't have time to talk about that here, but I'm just going to sort of, again, like I've done for the market analysis, show where you should focus for the pitch deck, and then where you should, and then how to go on to due diligence. So initially, you just want to prove that you're by yourselves, or we have an unfair advantage, and there's an upward trend, and you have a roadmap, and the team is awesome. Okay, a typical mistake that people get dragged into early on is they talk about competition and they go into a lot of details about the competition. But really don't, you have the stage, don't give a lot of message to your competitors and be succinct and understandable on that. The detail in terms of your competitors and substitutes comes in a due diligence stage. And there you start to do these types of diagrams using lists of all competitors and substitutes, product and financial comparison. You compare team backgrounds, competitive dynamics, and IP. An important thing that investors look at is sort of the dynamics that have happened since they first saw the company. So what is happening now and how has that changed in time? And of course, they want to look at your roadmap. And then, the next stage is just to continue to look at this into different sort of what if analysis. So trying to predict what the future might happen, try to predict major trends that might affect the market, and then figure out what is the plan.
Fantastic. That's really interesting. Now, we've had one question come in. Can VCs future-proof their investments from potential crises like this one? I think quite a good question.
That's a very good question. Well, it depends on how. It depends on a lot of things. So the first thing is we're not. We're still in the same world, right? So if there's a major economic downturn, and it gets so bad that we're sort of helicoptering in money, then it won't matter, right? We're still part of the economic system. I do think VCs, particularly early stage VCs, like we are in quite a good position in this type of downturn, in that we have invested in companies which we know what the timeline is. They don't need to worry so much around the top line. They still need to prove that they can get into the market, but they know that they're going to be there for X number of years, right? Where their funding timeline is. I think the other thing is that these companies won't have to go out and become profitable for a few years yet, so you can afford to let the economy balance out. I think the other great thing for early stage investments at this point is that the world has changed sort of fundamentally, and early stage investments or early stage companies are the quickest, most nimble people who have lots of smart people who are there trying to tackle a problem, and many of the things which were holding them back from a competitive and economic point of view have just suddenly been randomized. So they're on one hand sort of at the same place as many large companies. The world has changed, and they're trying to grapple with that. So I think that's kind of a business as usual for an early stage venture capital person like myself and the teams I work with, and really every time the world changes, we're looking at it as an opportunity and how we can go out and position the company. And our fund is several $100 million over X number of years, right? So like I said, we have a 10-year timeline. So we can afford to wait, and we can afford to back companies which are accumulating the evidence that they're going to win once the world has come back to normal. So I think it's not like we're unaffected. We really need to work hard with the teams that we've backed and try and figure out what we're going to do and what the plan is. But I think compared to many, we're in a pretty good space.
Interesting. Well, thank you for that. We've had I think we've had two questions come in, but I actually think you've already answered one of them from Stephen. Ask one, which is there a difference on pitch decks for angel investment and seed funding versus pitching for VC funding?
Yeah, so in the presentation I went through sort of the variables, right? So earlier on, when you're pitching to angels, which is earlier than VCs, right? You're just going to have fewer numbers. So you need to talk about the technology, you need to talk about the team, you need to talk about what you know about the market, what your access is to it, and focus on that. You'll still need other things like financials, market numbers, and so on, but they're more, like I said, they're more sort of establishing the size of the bubble or the space that you're operating in. And people don't take them as seriously. Financial models very early on are sort of sort of a finger in the air, kind of, this is what we might get to. People look at the ratios that you might achieve. Once you get to a VC type stage, then they might benchmark against industry standards and make sure that you're operating within the realm of the possible. So like I used a bridge type to get to that. They'll go and find gross margin, profit margin, other depreciation, typical type numbers, and benchmark to make sure that after 5 years time you're kind of going to back into an operating company which is going to be profitable, and we're not sort of building bridges to nowhere.
And have you seen much? I mean, obviously, I know we're operating in such alarmingly quick timetables here, but has there been the first faint stirrings of VC interest in, I guess, either directly COVID-19 related things or perhaps COVID adjacent things? Has there been like a flood of money, or is it everyone's more desperately trying to, strengthen their portfolio for the last few weeks and next few weeks before taking any decisions?
I would say it's more of the latter at the moment. people are trying to see sort of what the economic impact might be. You know, our fund has been around through several downturns, you know, the dot-com bust and so on. So we go back and use that sort of as a model, as to sort of sense check every week as to where we are, how bad we think it's going to get, and that dictates our sort of strategy. I think for right now, you know, us as a fund, it's very much situation as normal. We're making new investments. Like I said, the time spans that we look at are very much different. We do know in our portfolio, you know, certain companies are suddenly doing very well. Others, you know, the world has changed, they might not, but we still have to see. And again, that's just part and parcel of working with early stage companies.
Interesting. Yes, it wouldn't have been great to have been investing in some sort of travel technology, I suppose, at the moment.
Yeah, but you know, our investment thesis is that we focus on you know, breakthrough technology, and that means that it you know, can be applied to different industries. So if you have one, and perhaps the travel industry goes down, but you might pivot and look at another one, and that's, you know, that's perfectly normal and acceptable, and you try to salvage what you've got, and again, trying to build a big business in that other market. So you know, that's what I'm saying. That sort of fits our investment thesis and our way of looking at the world. And like I said, we've been through several downturns, so you know, hopefully we can advise our companies as best as possible as to how to navigate that.
Thank you, Daniel. Well, let's hope that lockdown doesn't last for the longer predictions, because I guess all bets are off for everyone if this is still going on come November. But now I'm mindful of the time. We have our next speaker here waiting. It's been a really interesting talk. I wonder, Daniel, if you'd be available to go on the Ask Me Anything channel in Slack for a little while, see if anyone has any questions for you if you have time. If not,
Yeah, sure.
it'd be nice.
Yeah, I can do that.
And I don't. That slide deck was fascinating. I mean, is that something you'd be willing or able to share with the participants, or is that more of a sort of private IQ thing?
Well, this, you know, what I've spoken about today is sort of my opinion on things. So I'll share it with you.
Lovely. Well, that's been a really interesting talk. Thanks so much for your time, and yeah, it's been a pleasure. Thank you all to all the attendees.